Welcome to Industry Focus. I'm Nick Sciple. This week, we're looking at dividend stocks. Motley Fool contributor Matt DiLallo joins me to give an update on our top dividend stock picks for the year 2020 and share a couple picks for dividend stocks to buy for 2021. Matt, thanks for joining me on the podcast once again.
Hey, thanks for having me again.
Great to have you back on. As I mentioned, we're going to be taking a look back at some dividend stocks that we pitched back on January 23rd, 2020, so about a year ago. See how those were performed. And take a look at a couple more dividend stocks that we might want to look at for 2021. But before we get into that, Matt, I know you're someone who invests in a lot of dividend stocks. It's a big part of your portfolio. Why are dividends an important part of your investing process?
Yeah, one of the early things I learned is that dividend stocks, especially those that grow their payouts consistently, they tend to outperform other stocks. So that just stuck with me early on. And then it's just so nice to get paid for something you didn't do. And that, it was like the first paycheck I got. I think it was like Procter and Gamble, maybe like 30 cents or something really small, but it was just to see that payment in my portfolio just stuck with me, and I've just been investing in dividends ever since.
Absolutely. Like an analogy I've just been kicking around in my brain recently is like, when you're a kid and you play like kickball and there's not enough people to play the game, so you have like ghost runners on base. And you've got to like knock the ghost runners. And I keep thinking about that as like investing, right? I put this money I worked and I put it away and I get to put these ghost runners on base. And sometimes we get dividends. Those runners are coming home, right? And you get that cash. So that's the way I've been thinking about it. So when you're looking for a dividend stock, Matt, what are some traits you look for? What are the criteria you're looking at?
Yeah, and my dividend strategies kind of changed over time because I've learned from all the mistakes that I made as an investor. And one of the early ones was yield. Like, if you saw a 10% yield, I would think in my mind, oh, that's great. I just sit back and collect the dividend. I don't have to worry about capital appreciation. But there's usually a reason for those bigger yields. And I've had enough of those blow up over time to realize that yield isn't the first thing to look for. Sustainability, durability, and more importantly, growth. As I mentioned, stocks that grow their dividends every year. There's been several studies out there that they tend to outperform the S&P 500. So I've focused more on like what companies can grow their dividends, not focusing so much on yield, but is this durable? And that strategy has really paid off, especially this year. A lot of companies cut their dividends, but some of those that really focus on that durability, they really shine this year.
Yeah, and Matt, that gives us a nice transition to talking about those stocks that we talked about back on the January 23rd, 2020 episode. We're going to do those in alphabetical order. I'm basically ripping a page right out of David Gardner's book. He'll always go through his 5-stop samplers in alphabetical order and give you a comparison against the market. So the first one in alphabetical order is Brookfield Infrastructure Partners, ticker BIP. Since January 2020, up 14% in total return. These are dividend stocks. We want to look at total return, lumping in the dividend, trailing the S&P by just a little bit, S&P 17.9%. What can you tell us about what Brookfield Infrastructure does and what's happened to them over the past year or so?
Yeah, so Brookfield Infrastructure, kind of like as the name implies, they own a bunch of infrastructure. In this case, they own pipelines, they own cell towers, data centers, all these kind of backbone type things that you need to function the economy. So they'll own those and operate those, and they sign long-term contracts with governments and with companies, and those contracts pay them steady cash flow, and that's what they use to support the dividend. And they've just really been a great company to own over the years because we've learned how important infrastructure is to the economy, and they've been on the forefront of kind of bringing something out there for just retail investors like myself to own this infrastructure that is just, great long-term investments.
Right. These are the things that are kind of the arteries of kind of our economy and things like that. You mentioned a couple big acquisitions this year. Can you tell us about those?
Yeah, so Brookfield, a lot of their growth is by acquisition. They bought cell towers in India. That was a big acquisition for them. They partnered with one of the big Indian telecom companies, bought this huge portfolio. It's backed by long-term contracts, and that's very important for mobile data. As we know in the United States, we use mobile data all the time. With our cell phones, we're always, checking videos when you're standing in line at the store or that sort of thing. And, so this one's in India. And then the other thing was they bought a stake in Cheniere Energy Partners, which is they own a big liquefied natural gas export facility in Louisiana. It was the first one that was ever built for export on the lower 48 states. And so they bought that stake from Blackstone Group, who really helped finance the construction of that project. They want to kind of monetize it. So it's two massive acquisitions. I think they spent $1 billion total for that, and great businesses throw off lots of cash. That's great for the dividend, which is really the main reason I'm buying Brookfield.
Right. When you talk about the cell towers, obviously with 5G coming on board, more and more demand for densification of those towers. And then on the LNG side, I mean, we've seen a lot of strong performance in LNG this year, Matt. I mean, does that say something about maybe they had some great timing with these acquisitions?
Well, and that's what's so great about Brookfield is they'll look for dislocations in the market. So when times are tough, that's when Brookfield will go and buy stuff. And earlier this year, the energy market just went, down the toilet, and that's when Brookfield was out there looking for these type of acquisitions. So they got a really good deal on Cheniere because at the time, LNG prices were low and they didn't know, what was going on. But LNG is just so vital for kind of this bridge fuel transition to renewable energy. It's so much cleaner than oil, and we can use it to generate power and to do a lot of things. So it's just a great business backed by long-term contracts, but there's some upside to the LNG prices too with that structure. So it was just a great timing. I think it's going to be a good long-term deal for them.
Yeah, so we'll see what happens there with Brookfield infrastructure on those deals. As we look out into 2021, what are the prospects for the dividend to increase over time and kind of deals on the horizon for them?
Yeah, so last year Brookfield actually did pretty well despite the pandemic. They're going to be up on the year, which is really surprising because they do have some economically sensitive businesses, some toll roads in South America, and then we got some railroads and ports. But as those bounce backs, like the headwinds are going to be turning into tailwinds. So you got that, and then they expected that deal for the cell towers to close early in the year. It didn't. It closed later in the year. So that's going to be a benefit. The LNG deal. So they could actually grow their earnings 20% this year, which is really a lot for when you're thinking about a slow, low risk company. That's a lot, and they've got a lot of organic growth too. They'll buy a business that they can do some expansion projects on them. I think this is going to be a good year for their earnings, and then the dividend. They're targeting 5 to 9% per year. I think they did 7% in 2020, so I would say 7% would be a safe bet this year. And if you have earnings growing at 20% and dividend growing only at 7%, that's going to make the dividend safer long term.
Yeah, when we've got a new administration in place, there's this joke of it's always infrastructure week. Well, maybe infrastructure week is coming once again here in 2021. Last thing before we move on from Brookfield Infrastructure, we always get this question about, okay, Brookfield Infrastructure Partners, that's ticker BIP. They've also come out with Brookfield Infrastructure Corporation, ticker BIPC. There's been a little bit of a difference in performance of those BIPC shares relative to BIP, also a difference in the corporate form. Can you just walk us through the puts and takes of owning those two different entities as an individual investor?
Yeah, so Brookfield Infrastructure Partners, BIP, that's basically a master limited partnership. And there's IRS regulations behind that of how much they have to pay out of their cash flow. And it's very popular in the energy sector, the past couple of years. But retail investors have kind of moved away from that because MLPs themselves blew up because of the oil market downturn. That's kind of like held Brookfield back. Retail investors just don't like that structure. And I can personally vouch for it. You get it's called a Schedule K1. It'll come sometimes in late March, and if you want to do your taxes, you have to wait for that. It can impact getting a mortgage. I know for myself, I had a couple of issues. I had to explain away that no, I'm not an actual partner in, like a law firm. It's a, publicly traded company. So there's been those issues. So to alleviate those issues, Brookfield is creating corporations that just make it easier for the average investor to buy that in an IRA specifically, because a lot of IRAs won't let you own a master limited partnership. So it just opened them up to this whole extra investor universe. And that's really why you've seen that relative outperformance because just the average investor, Brookfield's a great company. This is a way that they can own it. So it's been a really good idea for them.
Right. So maybe you've seen some people selling the BIP shares and buying the PIPC shares incrementally. You have more demand for those BIPC shares from certain shareholders. So I think over the long term, we'd expect those to trade relatively near to each other, if not identically, based on the assets that are underlying. Correct?
You would think so, but I think taxes will play a role into it. Some of the reason that MLPs have underperformed is because the Trump tax cuts a couple of years ago made corporations there wasn't such a big gap between corporate taxes and the MLPs that have this tax deferred. So, for example, if President Biden raises corporate taxes, that might make MLPs attractive again, and you could actually see it shift. Or you could just see investors just like, I don't want to deal with the hassle, and they'll stick with the corporate shares.
Yeah, so something to keep our eyes on as this new year plays out. Let's move on to the second company on the list. It's Enterprise Products Partners, ticker EPD, in the oil and gas space. So had a little bit of a tough year in 2020, minus 9% total return versus 18% for the S&P. So minus 27 points in 2020. So Jason, Matt, that begs the question: the stock lost money in 2020. How did that happen? I didn't
Yeah,
know they allowed that.
yeah. Well, there's several reasons. It's like that MLP piece that I mentioned, that's weighing on them because they're an MLP. Then you had the oil market just blow up, and so that's been an issue. But here's the thing with these infrastructure companies, and basically what Enterprises does is they own infrastructure. They own pipelines, processing plants, storage facilities, all backed by long-term contracts. So their cash flow is pretty good. There was some volumes that you know for example, if they're gathering oil and gas from an actual well, if that well was turned off, they're not going to get paid unless they have a minimum value contract. So there was a little bit of that that's weighing on them. But you also have just like this disdain from investors that don't want to oil and gas stocks. There last year, we'll talk about this in a little bit. Renewables was just like the thing, and so you've got that relative people just bailing on oil and gas and going to renewables, and so there's just so many things that were weighing on it last year.
Right, but at the end of the day, I guess long-term demand for oil and gas, the long-term kind of trajectory, I guess, hasn't been changed significantly when it comes to the pandemic. So I guess that the demand for these pipes, do you think that's changed in a meaningful way as a result of what happened in 2020?
I think it's still too early to tell. You'll have one camp that will say that the pandemic has just ruined oil and gas like we've hit the peak and it's never going to go higher again. Because, for example, one of the things that was going to drive a lot of the demand was airlines. We're just, we're traveling a lot more for work, and if here we are on Zoom right now, and if that becomes the kind of standard way that people do business meetings in the future, then you're not going to have the demand for airlines. On the converse side, if people just want to travel more overall and people want to do these meetings face to face, then we'll see it bounce back. So I really think it's up in the air, and that's why I'm leery about adding too much of these right now. But if you're just looking for stability, I still think there's a lot of oil and gas that we're going to consume in the years ahead. So I think they're going to generate a lot of cash for at least a decade or two more.
Right. So you look at the dividend yield today. You mentioned earlier, kind of, you see these high dividend yields. You want to be a little bit skeptical. They're in like the 8% range. How reliable do you see that payout being today? Any concerns there?
I don't have any concerns with them. There's lots of other energy ones that are in that same range or higher that I would have concerns with, but they generate a lot of cash. They have a lot of diversification. I think they cover it by 1.6 times their cash flow. So that's around a 60 something percent payout ratio. So that's pretty good. And then that other 40% or so cash that completely funds their expansion projects, and they're not expanding as much anymore, so that expansion spending is going to come down. So that's actually going to allow them to generate excess cash, which they'll use probably to buy back, some of these cheap units. They have a great balance sheet, investment grade, so paying off debt isn't an issue. So they're just very well positioned as the energy market bounces back. They could start doing acquisitions, to kind of fill in gaps in their system. So I really think that they're going to be one of the long term winners for whatever the energy market has.
Absolutely. Like I think we're still going to be using oil and gas going forward. Obviously, we're going to be driving around, be using oil for all the composites and things like that, plastics that use oil, and so this infrastructure is going to be important. The other thing you mentioned, Matt, about this idea they're not expanding as much, it's hard to build new pipelines. So one of the first acts of the new administration this week was to sign an order canceling the permit for the Keystone XL pipeline. This is something that's been back and forth, been a regulatory football going all the way back to 2008, but now it looks like there's finally the nail in the coffin of that pipeline project that was planned to take oil down from Canada down to the Gulf Coast of the U.S. for refining and things like that. Enterprise Products, obviously in the oil pipeline space. How does this regulatory action impact these other companies in the sector?
It could have a big impact because there's been issues with pipeline. Like that Keystone XL is only one example of the many pipelines that they've had problems getting built over the years, just because there's just this not in my backyard sentiment. Just the environmentalists and others that are conscious of the environment. Do why build a pipeline when we could spend that, putting in a wind farm or something that's actually good for the environment. So I think companies are going to be much more reluctant to build pipelines in the future. I know Williams Company, big natural gas pipeline company, their CEO came out and said doesn't, they're like, they don't think it makes sense to even pitch new pipeline projects right now. Uh, they had a problem getting a natural gas pipeline built, and natural gas, we've talked about it. It's a great bridge fuel, and even for those to have trouble getting built. So to build new pipelines, I think it's going to be problematic in the future. Companies are going to have to get really creative, and I know TC Energy, who wants to build Keystone XL. They've talked about spending an extra billion, $700 million to basically make that more of a greener project through solar power, wind power, and those sorts of things to reduce the carbon footprint. So if something like that is found acceptable, then maybe you'd see more pipelines get built. But I think we're in for several years where we're not going to see many pipelines built, and that could cause problems down the road, because if we do end up needing more oil and gas because demand increases, then we're just not going to have the infrastructure to kind of move that around.
Right. You hear Warren Buffett and Charlie Munger talk sometimes about like they're not going to put in new railroads, and maybe to a certain extent we're seeing things play out to maybe we're not going to put in new pipelines. So there's puts and takes here, but for enterprise products, they should be in a position to continue producing cash flow on a reliable basis going forward. Just any final thoughts on that company as kind of a future investment?
Yeah, I think there's two types of investors that should want to consider this. Value investors, because of the stock falling last year and it's been down for a couple of years, it's trading really cheap relative to its cash flow. So, if you have that kind of value bend, especially in the overheated market where there's everything seems to be trading at such a premium, that's, pipeline stocks in general are an interesting place to look for value. And then, if you're looking for yield, I really have a lot of confidence in Enterprise's yield. I think that one's one of the safer ones in the sector. But on the converse side, you have to put up with those K1s. So, it's something to keep in mind too.
Right. If they were able to maintain the dividend through what we just saw in 2020, you've kind of been stress tested for what could happen in a terrible scenario. So we'll see what happens going forward. But I think for a dividend investor, Enterprise still an attractive company to invest in. If you're looking for growth, some of these challenges around building new pipelines might limit just how big this whole industry can get. But we shall see. That last pick, Matt, NextEra Energy. This is the one that's really performed quite well. 32% total return, the number 2 overall performer in the utilities sector, outperforming the S&P. By 14%. What can you tell us about NextEra?
It's really so surprising sometimes when you see what stocks do so well. And NextEra is a utility. You think of a utility as, the slow growth, sluggish, they pay a dividend, but NextEra has in addition to the utility, so they own a massive utility in Florida, but they have one of the biggest renewable energy businesses in the world. And that's really what's been driving them. They've been a great total return play for the past, decade and a half because of this renewable energy. They've been really early in renewable energy. They're really good at building these projects, and that enables them to keep growing. Last year, it helped offset some demand issues with electricity, and it's the story with NextEra right now.
Right. I mean, they're kind of made the blueprint for some of these utilities, right? They leaned into renewables the earliest. They have, the market has rewarded them with, I think they're the highest valued utility on the market, Matt. I mean, do you know that offhand?
At one point, they were the top energy stock in the country, like more than Exxon and more than Chevron. So yeah, they're just really been highly rewarded for this.
Absolutely. So obviously, incredible performance. Looking backwards, they're in this Florida market, which obviously is going to continue to grow. We hear about everybody moving to Miami
Yeah.
right now. They're set up for renewables from a wind and solar point of view. I guess when you look out going forward, there's been such great returns for the stock in the rearview mirror. What are the prospects for continued promising returns from here?
Yeah, they've got a huge pipeline of projects. So, off the top of my head, they have 15 gigawatts of renewable energy projects, which is the biggest in the world. Their pipeline of new projects is bigger than that. So they basically are going to double their size over the next couple of years. Now they'll sell some of these and to help finance it, but they just have this huge backlog of projects, and it's only going to get better because the cost of solar panels specifically and battery storage is coming down to where NextEra thinks by 2023, 2024, it'll be cheaper to build a solar project with battery storage that makes it like basically steady power than a new natural gas power plant. So that's just game changing as far as the energy industry goes. And they're just a leader in battery storage. They're a leader in solar. So lots of growth coming up from them. And that's reflected in what they see ahead. They see 10% earnings growth this year. Remember, utility, 10% earnings growth is pretty fantastic. And then 6 to 8+% for 2022 and 23 on top of that. That's really good growth for what's one of the lowest risk companies out there, top notch balance sheet, one of the most conservative payout ratios for the dividend in the utility sector. So just it's a great way to play this growth.
Yeah, there's opportunity, right? And yeah, I think you look at NextEra, it's hard to find. You look at the past performance, you look at the opportunity going forward, you look at the enthusiasm around renewable energy. It's really hard to tell yourself a story about why things go wrong. But I'm going to ask you to do that, Matt, just because we said so many nice things about it. If what is, tell a story about how NextEra Energy as an investment might go wrong.
Well, we kind of mentioned valuation is becoming an issue in the stock market itself. And I think that's one thing that could become an issue. If you had a stock market crash just based on valuation, that could impact NextEra because they need to sell stock to help finance the growth. We mentioned Enterprise, they're self-funding all their growth, but NextEra is really reliant more on the market to help fund their growth. They have their own kind of partnership called NextEra Energy Partners, and they use that to help fund this equity portion of their growth. And if they can't sell stock either through that partnership or through themselves, that could impact their ability. They might have to take on too much debt. So that's just one example of how what looks like a no-brainer could blow up.
Yeah, so we shall see. Hopefully that doesn't happen. But if it does, we'll be here to talk about it, Matt. So on this kind of overall portfolio from 2020, down about 17 points behind the S&P when you lump everything together. Obviously got whacked a little bit with the enterprise products events. Kind of thoughts on that overall, and just from a dividend kind of income point of view, how do you think this portfolio held up?
You know, with income dividends type stocks, it's kind of tough to measure them against the S&P 500 if that's not your goal. And for a lot of dividend type investors, now I would love to outperform the S&P 500. That is my personal goal. But I'm okay with getting some underperformance for 1 year as long as I'm getting that income. Because for me personally, I use that to buy higher growth stocks. A lot of people, they'll reinvest it right into that company or they'll spend that money. So but for 11% return from low risk dividend stocks, I mean, I would take that year in, year out, no problem.
Yeah, and again, I think if you told me that we would hold up as well as we did, especially on the oil side of the business, the pipeline business, with all the kind of volatility throughout the year, I think things perform pretty well, all things considered. But we'll check back next year to see how that portfolio is continuing to do, and we've got a couple more stocks to add to the list that we can check back on, Matt. So first one on the list for our 2021 list, Brookfield Renewable. We've talked about this one a ton, but for folks who haven't heard us talk about it before, what can you tell us about Brookfield Renewable?
Well, if you remember the beginning of the segment, we talked about Brookfield Infrastructure. So this is the sibling company that they focus on, as the name suggests, renewable energy. They're mostly hydropower. That's kind of where they got their start. But They also own wind farms, and they've gotten into solar the past couple of years, and they sell that under long-term fixed rate contracts. They're called PPAs, power purchase agreements, basically to utilities and other big end users. And so it generates very steady cash flow, and they use that cash to pay the dividend. And then they'll reinvest some of it to build new projects and to make acquisitions.
Right. I mean, this is a company that ever since I've come on this podcast, so I've been hosting this podcast for like 3.5 years. We've been talking about Brookfield Renewable as a great way to invest in renewable energy the whole time, and it's been a great performer. Can you talk about kind of its track record of performance, and I guess what opportunities you see for continued growth from here?
Yeah, it starts at the top. Brookfield Asset Management's kind of the company behind these two entities, and they're just so good. They're, in my opinion, up there with the Warren Buffetts of the world. Obviously not as good as him, but they just have a great track record of allocating capital. They know how to make value investments, and so they look at it more from that value side of things. They'll look for opportunities to buy, renewable portfolio cheaper. For example, a company might be struggling financially, and so they'll grab, the renewable business, and they've used that to build these pipelines of projects, and so that's really helped them outperform. They always maintain a top-notch balance sheet, so that lets them access capital cheaper. And they're always looking for returns. For a long time, renewables was all about the government incentives, but as costs have come down, you've had these return focused companies like Brookfield getting in there. And so Brookfield, they know how to make money. And so that's the big thing. Like they know how to make money from solar now. They've figured out the best ways to, for solar. And they see so much growth in solar alone because of how good the returns can be with the costs coming down. And that's just, for me, it's really exciting to see.
Yeah, and so you look at with this Brookfield Renewable, it's the same type of factors we saw earlier of the Brookfield Infrastructure Partners and Brookfield Infrastructure Corporation. There's also a Brookfield Renewable Corporation, BEPC. Is it the same puts and takes here? Anything special to talk about relative to what we talked about earlier?
Yeah, it's the same type of thing. They in this case they use that to acquire the rest of Terraform Power, which is another renewable company that they own a stake in. And so in this case they use it as like an acquisition currency, and that's kind of something to keep an eye on, whether they use that to make other acquisitions in the space in the future.
Okay, yeah, and then kind of last thing, Matt, as we look at kind of opportunities in the future, you mentioned kind of this push into solar with Terraform Power. Historically, they had been a predominantly hydropower business. They still, I think, hydropower is the majority of what's bringing in revenues for the company. But as far as future opportunities, where they see room for growth, where are we seeing from this business?
Yeah, they've really they're going to become a solar dominated company in the next few years. They bought several pipelines of development projects. The company in, I think it was Spain, called Exilio, huge, massive pipeline of projects. They just bought Exelon, which is a utility in the United States. They bought their solar business, which came with a pipeline. They bought a huge project in Brazil, one of the largest solar projects in the country, and they believe they can get 20% returns on investment from that project. So lots of solar growth coming down, for them. They think within 10 years, solar could be the dominant business for them. And that's not because they don't like wind or hydro. It's just the returns that they can get because of how low cost solar has become is just too good to pass up.
Right. These guys go where the money is, where they can make the money, and they have these cash flows coming in from those other assets that they can redeploy. So really lots of runway for them. They perform well in the past, and hopefully they continue to do so in the future. And we'll keep talking about them on the podcast. So Matt, your other stock you have for us is Clearway Energy, CWEN is the ticker. And this is another one that if you look at past performance has performed quite well. So it was the top performer in the utility sector in the year 2020.
Yeah, they really did a great job last year. Part of that is one of their top customers is California utility PG&E. They had gone bankrupt, and so that kind of weighed on them, and that bankruptcy got settled. And so that freed up the cash flow that was kind of tied to that company because they had their lenders made basically restricted any cash that came from that because they want to make sure that they got paid. And so that freed up that cash flow, and they were able to boost the dividend. 59% last year was the dividend increase. And then they were able to use whatever cash that had kind of built up over the past year to make acquisitions. And they've just made several investments. And it's a similar concept to the Brookfield Asset Management, Brookfield Renewable Partnership, where they have actually two parents in their level. There's a private equity fund called Global Infrastructure Partners. they own their other parent, which is Clearway Energy Group, and Clearway Energy Group develops renewable energy projects. So you have this kind of these two parents that supply them with deals. So Global Energy or Global Infrastructure, they, for example, in the past have bought natural gas generating plants, so natural gas power plant, and then they'll sell it down. And then Clearway Energy Group, they'll develop a wind farm and then sell it down. So you have these two growth drivers, and that's just given them all these opportunities to make acquisitions and investments, which is given the dividend, the power needs to grow.
Right. So obviously, we're not going to see a 59% increase in the dividend here in 2021. We're maybe past that catalyst, but when you look out to this next year, still lots of opportunities for continued reinvestment with these partners.
Yeah, they're looking at 5 to 8% dividend growth for the next several years, probably 8% this year because of all the acquisitions last year. And a lot of the acquisitions they've made also have like a longer term catalyst. Like they'll buy a, for example, or are invested in a portfolio of projects that Clearway Energy Group is developing. And as that portfolio, each project kind of comes online, that's when they'll close the acquisition and they'll get that cash flow. And that gives them pretty good, solid visibility to all the way out to 2023. So you've got, steady growth coming, so that gives them a steady growing dividend. And so as long as investors don't sour on renewable energy, the total returns could still be decent from here.
Right, and it's hard to envision a future where we're going to turn around on renewable energy, just given how much force there is behind it from a public will point of view, a political point of view, all those sorts of things. Kind of maybe last question for you, Matt. We're talking about Clearway Energy, talking about Brookfield Renewable. They're both of these are part of these yield co type investments on renewable energy. And we talk about these a lot as an area that you want to look at as compared to solar panels or some of these other subsectors, at least if you're looking for reliability and something that's not going to be as volatile. Can you explain why that area is something that you look at specifically for investments?
It goes to how they're structuring their companies. You can kind of almost compare these yield cos to like the pipeline companies in the oil and gas industry, and then for example, your solar panel manufacturers have a lot of comparability to an oil and gas producer. Their sales go up and down with demand, and right now demand, for solar panels is going to be through the roof, so that's not so much an issue. But you're looking at that infrastructure, that steady cash flow, and so for a dividend investor, that's what you want, is that steady cash flow as opposed to the volatility that you'll get if even like solar panels this year, there were some declines because of the pandemic. It didn't impact returns, but it could in the future if there's a year where they change the tax structure, or there's just a bad year for solar that could really hit solar stocks, but it wouldn't so much hurt the cash flows of one of these yieldcos.
Right. So there's a lot more volatility in demand for putting in place renewable energy installations versus, once you're already producing power, listen, man, if the economy's good or the economy's bad, I need to turn the lights on at night and I need to turn the heat on and all those sorts of things. So a lot less volatility in the demand for that product that they're serving, if you want to talk about it that way.
Yeah, that's definitely how I would put it. And that stability, that's so key for dividends, because when you have that stable cash flow, and a lot of these contracts will be 10, 15 years, so you're just looking at just sitting back and collecting that income for a while.
Awesome, Matt. So that's Brookfield Renewable Energy, and that's Clearway Energy. You had one last watch list stock for us, Matt. People always love stock picks, so I figure maybe we'll run a little bit long. We'll give an extra stock pick in there. Can you tell us about that one for us?
Yeah, so this is kind of going off the energy beaten path, but it has a couple of REITs for the Motley Fool, and this is a real estate investment trust, and so these type of companies.
Gladstone Land is the name of it. Sorry, Matt. I didn't introduce it well for you. Gladstone Land is the name of the company.
Yeah, sorry, Gladstone Land. It's a real estate investment trust, and it owns farmland, which is, I think that's kind of unique. There's actually two out there that owns farmland, and they'll own, so you're not talking about your crops, your cornfields and wheat fields. They'll own like a pistachio orchard and a strawberry farm, and they'll lease that back or to a farmer. who actually farms it, and they get paid rent on that, and they pay a 3+% dividend monthly, and so who doesn't want to get paid monthly as opposed to quarterly? And they've had a good track record of growing it. I think it's 21 out of 24, the last 24 quarters they've increased that dividend, and it's just a neat way to kind of play that, the food growth that we have in the country, in the world. It's it's a safer as in more stable cash flow way. Their balance sheet is kind of a concern of mine. They're not like an investment grade rated company by any means, so that's kind of a concern. But it's something that's on my watch list, and so I thought I'd throw it out there.
Awesome. Yeah, I've never heard of this company. This is my first time hearing about this company. But the one fact I do have about farmland is I saw a headline the other day that apparently Bill Gates is now the biggest owner of farmland in the U.S. So, Bill Gates, smart guy. If he thinks it's a good investment, maybe I should pay a little bit of attention. We'll see.
Yeah, and even Warren Buffett, there's a story about him in farmland that he bought a farm a long time ago, and just the appreciation of the land value really did well for him. So farmland's an interesting investment. There aren't too many ways to invest it, and that's why it's kind of interesting stock.
Yeah, we might need to do a whole episode on farming stocks if folks are interested. And if you are, let me know. Email us at industryfocus at fool.com. Matt, thanks so much for coming on the show to share your thoughts and your stock ideas. Before we go away, I wanted to ask you one last question. We've talked about dividend stocks, reviewed some dividend stocks, look at some picks going into the future. For folks who are listening that are income investors, folks who are looking to invest in dividend stocks, what's your best piece of advice for those folks?
Do not look at the yield first. That has just been a bad practice for me in the past. Look at sustainability, look at the balance sheet, look at, if it's in a growth industry, but do not focus on that yield because that'll burn you.
Yeah, we said it twice because it's important, folks. So remember it. As always, people on the program may own companies discussed on the show, and the Motley Fool may have formal recommendations for or against the stocks discussed. So don't buy or sell anything based solely on what you hear. Thanks to Tim Sparks for mixing the show. For Matt DiLallo, I'm Nick Sciple. Thanks for listening, and Fool on.